We've all been told that diversification is the golden rule of investing and that it is the key to nailing our portfolio. But Ray Dalio says, think again. What if we tell you that the strategy that we've been taught our whole life is actually what's holding us back? In this video, we are breaking down why one of the biggest names in finance is warning us that diversification could actually destroy your portfolio. We're going to uncover his reasons, explore the hidden dangers, and reveal what he suggests is right instead. Your financial freedom depends on getting this right. Don't miss this chance to learn how Ray Dalio's strategies can safeguard your portfolio and unlock consistent growth. Diversification, the double-edged sword. Diversification is the good old golden rule of investing. But now, the legendary investor and founder of Bridgewater Associates, Ray Dalio, says that diversification might just destroy your portfolio. This guy has spent over 5 decades mastering the art of investing. He is the founder of the world's largest hedge fund, and previously, he has advocated for diversification. He himself has said that if done well, diversification can reduce your risk by up to 80%. But now, he's quick to warn against the blind approach to spreading your investments. And here's a quick foreshadowing. It's because people aren't doing it right. The true meaning of diversification. Diversification isn't just about owning a little bit of everything. It's about finding uncorrelated assets, ones that don't move in the same direction when the market shifts. To Dalio, diversification is the holy grail of investing, quite literally. But what does diversification really mean? Assume that each asset in your portfolio is a player on a sports team. Now, your goal isn't just to make sure that every player turns out to be a superstar. Your goal is to build a team where the strengths and weaknesses of each player balance each other out. This is exactly what Dalio focuses on. He focuses on the importance of uncorrelated assets, investments that don't react the same to market conditions, because this is what creates stability. As an investor, when you decide to add assets like stocks, bonds, real estate, or even gold and cryptocurrencies, you're not trying to spread the risk. You're trying to create a portfolio that is resilient. The pitfalls of over-diversification. Ray Dalio believes that one of the biggest mistakes that you can make as an investor is assuming that past performance guarantees future success. He has warned us that markets that have performed well are often more expensive and even more prone to sudden downturns than the others. And this is exactly where diversification becomes a double-edged sword. Because investing is already such a risky business, over-diversifying into the wrong assets can amplify your risks instead of reducing them. So for this, what Dalio suggests is not just diversifying for the sake of it. Instead, you should look into diversifying intelligently. Intelligent diversification, the Ray Dalio way. If you are going to diversify intelligently, you have to know some of the basics, right? First, you have to understand the economic cycles. Dalio breaks them into short-term and long-term debt cycles. So recognizing where you are in these cycles can help you anticipate market movements and adjust your portfolio. Let's say you are planning to invest now, but currently there's a recession in the market. So bonds can be the better option because they might perform better than stocks. Whereas during inflation, commodities like gold could shine. Knowing key information like this can help you to diversify in a way that prepares you for what's ahead. Balancing risk and return. Another critical concept Dalio focuses on is balancing risk and return. Many investors focus on maximizing returns, but they tend to ignore the risks they're taking on. Can you imagine putting all your money into high-growth tech stock? Sure, they might offer incredible returns during a bull market, but what about when the market crashes? What happens then? Your portfolio will take a hit. Dalio's approach involves creating a balance. He believes in diversifying across asset classes and regions because this will ensure that your portfolio is not overly exposed to any single risk. For example, if you hold US stocks, you should consider adding international equities or emerging market bonds so that it can reduce the dependency on one economy. The all-weather portfolio. One of Dalio's most famous contributions to the investing world is the all-weather portfolio. No need to get confused. This is just a collection of investments that are carefully designed to survive unscathed through any sort of market turbulence. According to Dalio, just like our usual seasons, the global economy also has 4 possible seasons at any given time. The first one is periods of high inflation. This is when prices go up and the purchasing power goes down. The second one is periods of deflation. This is when the prices of goods and services don't increase as quickly as expected or decrease. The third one is periods of improving economic growth. And the last one is periods of decreasing economic growth. Obviously, these 4 seasons are incompatible, so they can't occur simultaneously. But a portfolio that keeps growing, regardless of season, is possible. However, it's a rare mix and holds the secret to sustainable returns. This is what Dalio's all-weather portfolio looks like. His entire portfolio is as follows. First, we have 30% going to stocks, for growth during economic expansions. 40% is comprised of long-term bonds to provide stability and income during recessions. 15% is taken by intermediate-term bonds to balance the risk of long-term bonds. The remaining 15% is equally divided between gold as a hedge against inflation and commodities for protection against unexpected inflation. The idea here is not to chase the highest returns, but to achieve consistent performance with minimal risk. And his portfolio is the perfect example of how intelligent diversification can work in practice. So, when Ray Dalio said that diversification can mess up your portfolio, what he meant was that diversifying the wrong way can ruin things. However, if you follow the right steps and work your way through his principles, then diversifying can be your perfect weapon for your financial freedom. Now that we've learned a few of Dalio's most important principles, let's talk about some common mistakes that many investors make when trying to diversify. The first one is correlation confusion. Usually, investors assume that owning multiple stocks is what brings diversification to one's portfolio. But people often forget that if all those stocks are in the same sector, they're likely to move together. So make sure to invest in stocks from different sectors so that if one puts you into trouble, the others can get you out. Another common mistake is being overconfident about trends. Now, just because a sector is booming currently, it doesn't mean it will continue. So if you think diversifying based on current trends is a good technique, then you might have to think again because this can backfire when the trend reverses. While focusing on these two aspects is important, you must never ignore global opportunities either. So concentrating solely on domestic investments limits your portfolio's potential. You might think that you're just saving yourself from the risk, but what you're actually doing is ignoring the opportunities that can take your portfolio to the next level. Since we're already talking about the common mistakes, we can't forget to talk about neglecting the costs. Managing a highly diversified portfolio can lead to higher transaction costs and fees, and that can eat into your returns. Now let's finish up with Dalio's philosophy of risk parity. This strategy basically involves allocating investments based on risk rather than capital. Let's say you're putting 50% of your funds in stock and 50% of it in bonds. But with Dalio's risk parity, you will allocate 50% of your risk to stocks and the other 50% of risk to bonds. You can use this approach to ensure that no single asset class dominates your portfolio's risk profile. So if you're still confused about why Ray Dalio says diversification can destroy your portfolio, the answer lies in how you diversify. By following Dalio's principles of intelligent diversification, you can build a portfolio that thrives in any market condition. Dalio's bold stance flips everything we thought we knew. But maybe it's time to start playing it smart. Don't you think the same? Let us know in the comments below, and make sure to subscribe to our channel so that you can stay in the loop and never miss out on any of our videos. Subscribe now! See you in the next video.